Well, welcome everybody to our Lunch and Learn today. I think we have a very timely and pertinent discussion that we can have about a topic that has just come up in the last week. But before we get to that, I want to go ahead and talk a little bit about getting involved in corporate-owned life insurance, COLI, or I probably will refer to it as business-owned life insurance. But the first thing I want to say, and I know it's a little uh, distinct point, but I always get asked for a key man policy. And I just want to be sure everybody understands that there are no specifically designed products to handle a particular situation. What we have is that a company enters into an agreement, either the two owners of the company, maybe with a key employee, however, but there's an agreement that's involved, and then the life insurance policy is used to fund those agreements or liabilities when they come due. For example, in a buy-sell agreement, one entity says, or the agreement says, if one shareholder becomes disabled or passes away, then the other shareholder is going to buy them out. That's the agreement. Really has nothing to do with the life insurance policy itself, other than the fact that life insurance policy has to have the correct owners, beneficiary designations in order to accomplish the task that the document sets out. And sometimes we find those two are not in concert or in agreement, and the agreement says one thing, and the life insurance contract that's supposed to fund that liability says something different. So with that started, what I want to talk about is getting involved in the corporate-owned business. So I guess we think of these corporations are the ones that have the money. The corporate pocketbook is typically larger than the individual's pocketbook. Now, quite frankly, I've never been very successful with doctors or dentists because I don't have the patience to wait on them to make a decision. Business owners, on the other hand, are accustomed to making decisions. So they will make decisions, sometimes good, sometimes bad. They make decisions and move forward. So, excuse me. So with those two things in mind, to me, that puts a better environment to make sales, be productive, and move on to the next client or sale. But to do that, I think you have to start with having an understanding of how the different corporations and entities might be formed. We use corporate pretty liberal, but here are some different types of corporations. Now, I don't typically like to use company material. When I was doing my research and putting together the topics I wanted to cover, I found that there were a lot of good pieces out there that were available to us as advisors. These do have the company logo on it, so I'm going to give credit where credit is due. This one is a John Hancock piece, but I've looked at others. Others have similar things. I just like this one a little bit better. So at the top here, you will see the different types of entities, starting off with a sole proprietor, going to a general partnership, limited partnership, C Corp, S Corp, LLC, LLP, and professional corporation. Now, and here are some of the characteristics of each. As advisors, we need to know this because they are taxed differently. There are two basic rules for the taxation. It's either taxed at the corporate level, which is the C corporation, which was the beginning when they started forming corporations. I don't know when that was, in the 1900s or before. That's where it all started, where there was a C corporation. So the C corporation files its own taxes, pays its own taxes. That's typically a Form 1120 for the corporate S corp for the C corporation. I'm not sure when S corporations came around. I didn't look at that, but that is what they call can be a pass-through entity for if you elect the S election. That means the partners are taxed. The corporation itself does not pay tax at the corporate level. It's all passed through to the owners and the shareholder.
Excuse me, Ralph. Would you
Yes.
mind enlarging that screen? It is very small.
Oh,
Right there on the right, on that, on the right, that right, you go down to the bottom.
yeah.
You got a little
Okay.
magnifying thing.
Uh,
It's at the bottom. Yeah, right in there. Thank
okay.
you. Appreciate it.
Okay. Sorry. Thank you. Uh, it's large enough for me. I'm sorry it wasn't large enough for you. So, as I say, the LLC now can be the members of the LLC can choose to be either taxed as a C corporation or as a pass-through entity. I'd almost be willing to say 90% of the people in an LLC choose to be taxed on a pass-through basis. Not all, but most. Now, the good thing about the Hancock is if you go down to the later pages, it gives you a brief one-paragraph description, sometimes two in the limited partnership, of each of those entities. I would suggest if you want to get involved in the business-owned life insurance, you familiarize yourself with this table as well as the different forms of entities. To me, that is a starting point. Okay. Now, let's move on to a topic that has come up. This is something that's going to make it very easy in the next year for you to go back to anybody that owns a business and talk to them about their agreements. Remember, that is the basis for why they need to buy life insurance, is what's written in their agreement. There's a recent decision by the Supreme Court. In fact, it was last Thursday, so it's 7 days old. It's called the Connolly decision. You may have heard of this. It's IRS, Connolly versus the United States. It involved a buy-sell agreement, which was a stock redemption. There are two ways to do a buy-sell. It's either a stock redemption, where the entity buys the shares of the deceased shareholder, or a cross purchase. In a cross purchase, the surviving members or partners buy out the deceased partner's value. The Connolly decision has to do with stock redemptions. So the Connolly brothers owned a corporation, and they said the corporation was going to buy the shares of stock from the decedent. The value of the business was about $3.5 million. There was a life insurance policy of $3 million paid into the corporation at the death of one of the brothers. The IRS ruled that at the time of death, that the total amount, including the life insurance proceeds of $6.5 million, was includable in the estate of the deceased brother, effectively making the life insurance proceeds subject to estate taxes to the tune of about $900,000. The Connollys appealed. IRS just confirmed it on a 9-0 vote. How many times do you see the Supreme Court come in with a 9-0 vote to uphold the IRS interpretation that the value of the life insurance proceeds increase the value of the estate, increase the value of the business, and therefore the value of the estate? Now, what does that mean to us? Well, right now the estate tax exemption is $13.6 million for a single individual and $27 million for a married couple. So if the value of the business plus all the other assets that the insureds own and the proceeds of life insurance are not greater than $27 million, you probably don't have a problem with the Connolly decision. Unfortunately, if it's a single person, it's $13 million, $13.6 million. You have a $3 or $5 million life insurance policy owned by the corporation, now you might have an estate tax problem. Also, that business might grow over time. So there are lots of problems that the Connolly decision has thrown into stock redemption plans at the decedent's passing. Now, so how do you know what kind of agreement the company has? Well, I'm going to switch to this. Here's a release form for your client to sign to get information about the policies that are funding that buy-sell agreement. You don't necessarily have to ask for the agreement, because you'll see that we're asking for owner beneficiary designation. And if the corporation is the owner of the policy, it's probably going to be a stock redemption. Even if it's a cross purchase, sometimes the owners and beneficiaries are not correct. For example, if they have a policy on John and John's wife is the beneficiary, that's going to foul up the cross purchase, because now John's spouse owns not only the insurance proceeds, she still owns the shares of stock. So this is very non-threatening to ask your business client owners. Let me just do a little bit of research. All you got to do is sign the form. I'm going to go out and do all the homework, find out a little bit about your policy, what it means, see if I see any deficiencies in it. I might come back. We might want to review the buy-sell after we do this, or whatever documents you have. Sometimes these buy-sell documents, they were never completed and finished. There's a lot of problems and they never really get done because they think they're done. They put them on the shelf, and that's it. Oh, one thing I need to mention too about the Connolly decision. What about contracts that were issued 10 years ago? There is no grandfathering. This is going to be, excuse me, it's going to be what happens at the time of the death of the insured. So no grandfathering. Again, so what we suggest, go ahead and get this, and this is not an agent of record letter, by the way. This is a release of information. An agent of record letter is going to probably notify the original agent that they're going to be releasing information to someone else. This one, the agent typically does not get informed to know that you may be snooping around as to what's going on in the policy. I would suggest you name yourself and broker house insurance in this, because you may, excuse me, you may or may not be contracted with the carriers. They may require contracting before they'll release this information. We're licensed with most carriers, so we can probably get this information for you. So that's one thing. Talk about the Connolly decision. Ask if they're aware of the Connolly decision, and has it affected any documents or agreements they've got in place on their buy-sell. I'm going to tell you probably 90% of them are not going to know what you're talking about by the Connolly, but it's a significant and very significant impact on buy-sell agreements. Now, I talked about cross-purchase. I'm not going to go into that. We're going to kind of do this at a 30,000-foot level to look at talking about, we'll include buy-sell agreements, key man insurance, talk about supplemental retirement planning or deferred compensation, and the last one would be succession planning. But this is going to be at a very high level. All we want to do is try to get your foot in the door so you can talk more. Each of those topics are probably easily take up an hour's time in a lunch and learn. So again, it's going to be a very high level conversation we're going through. The next thing out there that I think is a very good point to talk to about your business clients is something called Section 101J. Here are the requirements of Section 101J. First of all, it tells you who is eligible for a corporation to own a policy on an individual. And this one is a Lincoln one, so I'll give Lincoln their due on this one. So it gives you about 4 or 5 reasons that one of these conditions must be met. And it could be to buy an equity interest, or it's a highly compensated employee, but one of those has to be met. Now, here's where we fall short on the "and" portion. The employer must notify and receive consent in writing from the insured employee prior to the issue of the policy. Okay? So I pulled up a consent form that we use. Here it is. Some companies ask for it before the policy is issued. Some do not. Here's one that we use. Very easy. It's available to you. All you got to do is ask us for it, and we'll send it to you. But let's go back to this. Now, just because the insurer does a physical exam and knows that he had to get an exam to get an insurance policy, that does not meet the IRS requirement that it has to be in writing and it has to be on a form. Now, the other thing, and I have been looking for this, I don't believe that if your failure to do that is curable. What do I mean by that? Well, the IRS has said if there was a mistake and you can go back and correct it up through the end of the taxable year of the policy date. So if you had a policy date dated in 23 or prior, I don't see where you can cure and go back and get the consent in writing. Somebody may correct me on that, but I have looked and looked and looked and can't find anything that says just up to the end of the taxable year. And that's the corporate tax year, not the individual. So corporate tax years could be a little different because they don't necessarily file with calendar year. Now, so you have to notify the beneficiary of the life policy. And then lastly, here's another one that nobody knows of. I've talked to accountants. They're not aware of this form 4925, which needs to be filed with the IRS. And it asks them about their employer-owned life insurance contracts. So, again, are they compliant? Probably not. You need to ask them if they've been filing their 8925 form. I just, again, you got a problem if they haven't been doing that. I've not found anything that says about the 8925 form, if you haven't been filing that, if that's curable or not either. Okay, this is going to be the way they're going to keep up with this. Now, what does that mean to the corporation if you don't meet these requirements? Well, the IRS is going to say that the amount of death benefit less the premiums paid is going to be a taxable event to the corporation. So all of a sudden, that $1 million death benefit is now $750,000 or $800,000 of after-tax proceeds. May not be what you want. So again, you got to go in there. That's a second reason to ask them. In addition, the Connolly says, let me ask you about any insurance policies the company owns. Have you been filing this 8925 form? Have you been getting signed notification from the employee that you're getting an insurance policy on them? Those are two pretty serious consequences if they haven't been doing them. Okay? Now, what do you do to cure them? I can't give you an answer to that right now. There's so many variables that are going to be that you're going to have to look at. Each case is going to be different to propose a solution. But that's why we're here. Todd is an advanced planning expert. I consider myself to be pretty good. We're going to help you come up with a conclusion and go back and be able to make a presentation to your client as to what they need to do in order to satisfy their problems or get a better solution. I mean, not satisfy, be a better solution than their current situation. Now, let's move on. Ask also, sometimes some people work off fact finders. We have business fact finders that we can get. This one is a Lincoln piece. It's a fillable PDF. These are available to you on the Lincoln website, or we can send you a link. Just let us know. Again, Lincoln's got one, Principal's got one, Hancock's got one, you name it, they're out there, okay? But this can help you. I personally don't like to do a fact finder because I like to be listening to what the client is saying and then kind of hone in on the hot spots of what that client wants to talk about. Now, let me see, there was one other one I wanted to talk about was executive benefits. And I didn't show this. That would be the third piece. And this one's a Hancock piece. And, oh, I take that back. I think it's a Lincoln piece. I apologize. I thought I had the right one up. Hmm. Well, here it is. Here's the executive benefit spectrum. Executive benefits come in various forms, how you might want to do it. This to me is a very good chart to explain that. Again, this is a fairly high level of this. Oh, I'm going the wrong way. Now, so a lot of this has to do with who controls the values of the contract. Because typically, we talked about the agreement being in place. The employer is entering into an agreement with the key person that they're going to provide additional benefits to that key person. Now, that is typically funded with a life insurance policy. So the question is, who owns those values during the time between the participation date and the retirement date, or the date that benefits become available? Is the employee going to control it, or is the employer going to control it? Executive bonus, Section 162 plans, it's in favor of the employee. Non-qualified deferred comp, sir, some of these that you may have heard, some of the terminology is the employer controls that asset and only has a liability to the employee. And in the middle is a split dollar plan. Another good piece, just kind of talk and say, as an employer wants to do something, what kind of handcuffs do they want to have on that money or that benefit being given to the key employee? Now, the last thing that I think about is exit strategy and not knowing how to, for an entrepreneur, know how to exit his business, his or her business. They really have no clue. They've not thought about that. But I will tell you, this is my own personal thing, that the years from 50 to where I am now at 68, they went by real fast. At 50, I wasn't concerned about because I was going to live forever. 68, just a little different, but they don't think about it. So that's one of the things that you talk about. And we can do business valuations for you through the carriers. This is an actual case. You may have heard me talk about it before. We had a firm that they thought they were going to sell their business for about $5 million. They wanted to work another couple of years. So they didn't think that would give them quite enough money to retire in the style they wanted to retire. We did the valuation on it, and it came out that the company was worth $27 million. That was a far cry from that. All of a sudden, the husband in the group says, well, I'm ready to retire now. When it went from 5 to 27, they recently closed a deal on it for a portion of the business for $18 million. And the husband's staying on for a couple of other years in the other part of the business that's probably worth now $6 or $8 million itself. Entrepreneurs do not know what their business is worth. Business valuation is pretty easy. Need some balance sheets and income statements and tax returns, and we can work on those to give a more accurate valuation of what a company is worth. Now, so again, part of this, and I know I'm trying to keep this to 30 minutes. So part of this, we're going to talk about how to approach and get involved in business-owned life insurance. Well, first of all, I think you need to start with learning about the entities. Two ways we've talked about approaching is either talking about the Connolly decision or talking about Form 8925. The third one I'm going to tell you is to try to get the business owner to stop and think and listen to what you're saying. Sometimes you have to pull out a hammer and hit them over the head because what you think is obvious is not obvious to them. So here is a scenario that I've used to get them more in tune with thinking about what really needs to be thought about as far as succession planning or key man coverage. But here goes. So I'm going to say, Judy, Chrissy's a valuable person in your company, isn't she? She is the one that comes in on Monday morning goes through all the things that need to be accomplished that week, sends the technicians out to do their task. She is the hub of information, is she not? And Judy says, yes. I said, Judy, I want you to stop a second and tell me what that Monday morning meeting is going to look like on Monday if Christy is unable to come to work due to a disability or unfortunately has passed away. Are you going to run that meeting? Who is going to run that meeting? Is it going to cost your company money? At least it stops and says, you need to think about this. They have never thought about it in those terms. They're saying, excuse the language, oh shit, I'm not ready to run that meeting. Who is? And we're buying you time with a life insurance policy or a disability policy on Christy to give you, Judy, your company time, find a replacement, or to make up for that loss of income that you might suffer if Christy's not here. If Christy's not directing traffic and John's business out there needs their air conditioner fixed and it's not fixed, John may go somewhere else and never come back. So, again, 3 ways to talk to somebody. Connolly, Form 8925, and the Monday morning meeting. With that, I'm going to stop my part of the session and open it up to questions. So, Christy, do we have any questions from anybody?
Hey, we have, let me see. We have, and I think you kind of covered, we have a couple. One of them, how can I get some of the brochure that you showed? That, give a breakdown of what you showed. So that was some of the other carrier stuff you talked about as far as going to Principal or Lincoln site, or we can send it along if they email us.
All right. The easiest answer for that is that if you're appointed with a carrier, you should have login information. And the login information actually see your book of business also. That's the easiest way. So you can see all the forms that Lincoln has available to you or all that Hancock has available to you. You can print them all, get them sent to you, whatever. Again, and I just use those 2. Penn Mutual has some, Principal has some. Any of these companies that are known for their business insurance would have something like this. The other thing is, like I said, you can email David or Jetty, and we can get those forms or get a link and send it to you so that you can get to the forms.
And then I think kind of in that same vein, I have a case that I think I can discuss with you all. What is the best way to set that up with you? So again, a contact kind of direction for them.
Well, you can either reach out to Todd, T. Wachtel, WACHTEL at Brokerhouse INS, or you can reach out to me, R. Moore at brokerhouseins.com. I will tell you, I am going on vacation tomorrow afternoon. We'll be gone for 2 weeks. So if you got something pressing, I'm not sure who that is. If you got something pressing, it's probably going to, unless you want to do it sometime tomorrow afternoon, Todd is going to be the better person to talk to because I'm just not going to be available.
Okay, and then we have Melissa. Please send me the business fact finder. So we can follow up with Melissa and send her that fillable PDF you showed.
Just by a show of hands, or if you would respond, how many of you, because the Connolly decision's been out there for about, I'd say a year, maybe 18 months. I'm not sure how long it's been out there, but the Supreme Court ruling is a week old. So first of all, how many of you are aware of the Connolly decision, and how many of you are aware that the Supreme Court just reaffirmed that decision? Nobody? Not many? Chrissy, looks like Karen Powell has her hand raised for something. Oh, maybe not. All right. Do we have any other questions? If you do, raise your hand and we'll unmute you and you can talk. I hope that was what you were expecting, because I gave you some firm reasons to go out and talk to business owners. We didn't get down into talking about exactly how a buy-sell works or anything like that. But I just got off a call actually with one of the carriers about the Conley decision. And again, since it's so new, they think that the insurance LLCs will become very popular to replace stock redemption buy-sells. Again, it's something that's fairly new, but we can sit down and talk to you, answer your questions. At this point, I'm going to say almost each case has to work on its own because some of those stock redemptions are funded by term insurance. Some of them may be funded by existing permanent life insurance policies when you may have an issue with transferring them out of the corporation, either with a transfer for value problem or having to recognize a taxable gain. So again, each one is going to be different. I would suggest that if you open the conversation, it's not difficult to say, you know, Tom, Ted, that's a good question. I don't have an answer for it, but I have someone that is experienced in this area. We can get back with you and answer your question. But at least you've made them uncomfortable enough to start a conversation. And that's where every sale starts.
Ralph, we have a question from Karen. Did you see that? Says, do any of these companies have a calculation software that can help extrapolate the growth of company and impact on buy, sell, and exit planning?
Yeah, I'm sure that I don't know of one in particular. Most of those valuations are a current date valuation. You know, and then it would be very easily to extrapolate if the company is going to grow at 5%, 3%, or whatever it might be, to extrapolate from there. I just don't know if it's actually in the software to give you something 3 to 5 years from now.
Okay.
That's a good question, though, Karen.
Yeah. I think that's it. I'm just kind of passing along your and Todd's contact information as well on here. And we can, you know, if anyone emails me or David or anyone else on the team, we can send you guys all this. But I'm putting it here just in case y'all want to copy and paste it to your contacts and Outlook.
Yeah, like I said, just like be aware that the Conley decision is brand new. And if you've got clients who own large life insurance policies in the corporation, or they have large net worth, it will certainly affect them. The others, I mean, a person who thinks they're not subject to estate taxes, but the corporation owns a $3 or $5 million policy on their life, that all of a sudden could throw them into a taxable estate. It's very timely. You will be one of the first to talk to them about it if you get out and do that, you know, in the near future. All right. Anything else? Well, again, I hope you found this to be beneficial. We're available to give us a call or email us, and we can help you with your cases or give you some more direction. But I really think if we go back to this, not the consent form, but this form right here, which is just authorization form to gain information, there's a lot of value and we can glean from this. And when you have knowledge, then that's very powerful to be able to present a solution or an alternative to what they're currently doing. So thank you very much. Y'all have a great day. I hope you enjoyed it.